Welcome to the award-winning Moneymakers podcast. I'm Jonathan Davis, the founder and host. For more than 6 years now, we've been providing comment and discussion about all the latest developments in the world of investment trusts, the stock market listed funds often called the City of London's best-kept secret. I'm grateful to JP Morgan Asset Management for their continued no-strings support, which enables us to keep the podcast free while preserving our truly important independent editorial principles. Please note that while our comments are well-researched and our opinions honestly held, we do not offer individual stock recommendations. It's been another positive week for the world equity markets, with bond yields coming down a little and the oil price falling, and most indices from leading countries hitting all-time highs, despite a range of concerns, the traditional wall of worry. Against that backdrop, this week on the podcast, I shall be talking to two managers who have an interest in global markets, not just the UK. The first of those is Roddy Snell, who is the lead manager of the Pacific Horizon Investment Trust, ticker PHI, has a market cap of somewhere around 800 million or so. He's been the manager since 2021. And before that, deputy manager. Pacific Horizon is a Baillie Gifford trust with a strong growth mandate. And secondly, I should be talking to Nish Patel, who has been the lead manager of the Global Smaller Companies Trust since 2024. There's an interesting story here as well. This trust, which dates back a long way, was for many years part of the F&C stable, now part of Columbia Threadneedle's stable of investment trusts, has been undergoing a significant revamp in the last couple of years, changing the way it's managed and looking to exploit what it hopes will be a continued recovery in small cap equities around the globe. So more on that in a moment. But first, my call with Roddy Snell. So, Roddy, welcome to the podcast. I guess we could say that the last 18 months have been particularly interesting and exciting for your trust. You've put in a really crackerjack performance, I think we can say, albeit one that followed a number of years of relative underperformance. But the long-term record is very, very good. So can I say that this is the kind of year that you get to live for with your trust?
Sure, it's certainly been a good 12, 18 months. And I suppose in many ways that's the nature of long-term acting investing in the region. We're trying to take positions that make us look different from the market, and a shorter term time horizons, 12 months, we will be out of tune with the market from time to time. So we probably only outperform 60 or 70% of the time on a 1 year basis. But the longer you extend that time horizon, the more frequently we will outperform. So, typically 95% of the time we'll outperform over a 5-year period, and always 100% over 10 years. So it can be volatile in Asia, but we do think it's right to stick to our guns and invest in the areas where we think we can make the most money over a 5-year plus time period. And certainly, thanks to a number of our holdings, particularly in Korea and China over the past 12 months, the trust has done very well.
Indeed it has, but it's been a volatile ride over time, with significant outperformance over 10 years, not quite so good over shorter periods. And of course it's been particularly turbocharged in the last 18 months by the arrival of Donald Trump as president, and the continuing strong performance of anything related to AI, at least until the last few weeks. AI has certainly been one of the themes in your portfolio, I think it's fair to say. And as a growth investor, you've actually been investing in some of these very large companies which are capitalizing on the AI revolution. Is that a fair summary?
Yeah, I think that's broadly right. We're probably a bit different from most other funds at Baillie Gifford, and we do have a broader mixture of growth businesses. So in part because of the makeup of Asian markets, we've always had a lot more cyclical businesses in the portfolio. So yes, we do have a large amount of tech-focused companies, particularly on the AI theme at one end of the portfolio. But at the other end, we don't actually have a large amount of businesses you might not expect in a growth portfolio, particularly at Baillie Gifford, sort of autos, industrials, energy, etc. So in some ways, the portfolio looks a little bit like a barbell. You've got sort of cyclical growth at one end and rapid growth at the other. And this year, it's been rapid growth that's really helped. But if you go back over the past 2 or 3 years, actually some of those cyclical growth names, particularly in copper, for example, that have really helped the portfolio.
Now, you also run an open-ended fund, which has, I think, broadly the same mandate, but is larger than the investment trust. I wonder what you feel about the attractions of managing an investment trust and the advantages that are always claimed for that structure. What has been the relative performance of those two vehicles? I imagine the open-ended fund has been a little bit less volatile because of the movement in the discount that we've seen. But in terms of performance numbers, how do they stack up?
Sure. I mean, in the very long term, broadly similar. But if you look over the past sort of 2 to 3 years, then Pacific Horizon, the investment trust, has been the better performer out of the two. And that's partly because we can have a bit of leverage in the trust, and we have a little bit on at the moment. But also, given the closed-ended nature of the trust, we can get into some more smaller, less liquid positions. A stream end of that, we do have some unlisted businesses, some of which have done pretty well over the past 12 months. The likes of ByteDance, which is our largest unlisted holding, which is the leader of TikTok, has been a pretty decent performer. But also some of the less liquid listed companies that you can invest in have done really well. So one of the best performers for the trust this year was a company called Knowledge Atlas, known more commonly as Zhipu, which is one of the first Chinese large language models to IPO this year. We were very fortunate, partly because of the Baillie Gifford name, that we got one of the biggest allocations to an incredibly hot IPO, and the stock was up 8 or 9-fold over the following 3 or 4 months. We subsequently sold out of that position. But being able to get into some of those smaller, less liquid names has been one of the key reasons for the better outperformance over the past 12 to 18 months.
How much commonality is there between the stocks that you own and the stocks that are owned in other Baillie Gifford investment trusts? Obviously, that can be an advantage when it comes to securing allocations in IPOs, for example. But can you generalize at all? Obviously, you have a very different mandate from some of the other trusts that Baillie Gifford manages, but how much commonality is there?
So if I exclude our emerging markets team that I'm on, where we have some emerging markets funds, which are 80% of the EM index would be Asia. But if you look more broadly outside of the other funds at Baillie Gifford, then not that much. Some of the other global and international funds will own some of the bigger names in Asia, the likes of TSMC, Samsung, Alibaba, Tencent. But you're probably talking names owned in the trust that are owned elsewhere in Baillie Gifford, outside of the emerging markets team. You're probably talking less than 10. Particularly for the investment trust, where a large portion of our holdings are relatively small and less liquid than what our other funds would typically be investing in. Plus, we do have a broader remit of growth. So actually a large section of our portfolio, that more cyclical growth area, is not so widely held throughout the rest of the firm. So not that much would be how I describe the positioning.
You happily describe yourself as a growth manager. Indeed, I think I've seen you quoted as saying that your strategy is, quote, growth squared, close quotes. Now, obviously, growth as a style in investment has its good and bad periods. There was a poor period for 2 to 3 years after the post-COVID pandemic surge. Do you think those conditions have changed back now on a more permanent basis? Obviously, they've moved in your favour in the last 12 to 18 months. But do you think that's going to be a permanent style change, or at least a consistent change, I should say?
Yeah, I think that's a difficult one to answer, because there was a period, I suppose before 2020, when growth had a significant tailwind all round because you had very, very low interest rates globally, often negative, zero or even negative in some places. And clearly that is a big tailwind for growth assets, particularly those where cash flows are some way into the future. Now, it looks unlikely that we're going to go back to a period like that anytime soon, if not in the very long term. I think that was an extremely anomalous moment. So I think that sort of fantastic tailwind that all growth companies had for a decade after the global financial crisis probably doesn't come back. So what does that mean for, I suppose, growth investing? Well, I still think there are fantastic growth businesses out there, and providing you are taking a differentiated approach, for us, I think that's ultimately being long term, and finding the good businesses at the right valuations, then you can make an awful lot of money. I mean, you take the situation we're in today, and I would say with a high degree of confidence that AI is one of, if not the biggest investment themes in history. And this is exactly the sort of area where if you can find the right companies, you can make a lot of money. Every so often, new technology comes along that changes the world. Now, over my lifetime, that's been the PC, the internet, then smartphones, each one of those fundamentally changing the way we operated and the world worked. And why is AI the most powerful of them all? Well, it's because it's replicating what has made us ultimately the most successful species in history. It's what led to all our great inventions in the first place: intelligence. And it's going to get exponentially more and more powerful. It's impossible to imagine what this can unlock, but it will change almost everything we can do. And the only thing holding it back at the moment is not demand. I think demand is almost infinite. The more AI you have, the more you can do. The constraint is compute at the moment. So for growth investors, I think we have the strongest theme we have had in history. And as we have demonstrated for the past 12 or 18 months, you can make an awful lot of money from that. It will be volatile, valuations will get stretched here and there, etc. But as a theme over the next 10 years, I don't think there can be a better place than the transformation we're seeing in technology at the moment. So yes, the great tailwinds of interest rates collapsing has gone, but equally, I think the technological transformations that we're seeing are accelerating at a pace we've never seen before, and that's a great place to be for long-term growth.
I guess the challenge here is to find which parts of the AI universe you should be putting your money into. There's obviously quite a lot of choice. I have the hyperscalers at one end, then the picks and shovels, then the memory and the chip manufacturers, and so on. How have you played that theme? Of course, we know that the markets you do invest in have been quite heavily concentrated around few names, particularly in memory and chips. How have you navigated that?
Sure, big picture, when you have exponential growth like this in a new technology, typically the best places to invest are in the picks and shovels where there are critical bottlenecks. So that is where we've been for the past 18 months, 24 months. So we have had big positions in memory, foundry, and we have reduced those over the past 6 months and have been putting those into other areas in Taiwan, other parts of the supply chain where the valuations hadn't caught up so much, and we still think there's significant upside. But ultimately, I think the big picture here and why Asia does well is that Korea and Taiwan, and perhaps China, ultimately sit at the center of the global semiconductor and AI supply chain. And it's interesting, when I was in the US a few weeks ago, the debate I heard the whole time is whether AI will make money. In Asia, it's the complete opposite. It's how much. And the situation is different because Asian companies are the key picks and shovels of the AI arms race, sitting at those critical bottlenecks. And they're completely agnostic as to who wins that race. They will just supply the critical infrastructure to everyone. So TSMC in Taiwan, it is the only foundry in the world that can make the most advanced AI chips. No TSMC, no NVIDIA. You take Samsung and Hynix, two of our big holdings that we have been trimming back, but they dominate high bin bandwidth memory, which is the most acute bottleneck in the whole AI chain today. To put that in perspective, GPU speeds are up about 60,000 times this decade, memory bandwidth less than 100 times. So GPUs are actually sitting idle most of the time because they can't get enough memory, which is why companies like Hynix have sold out of memory for the next 2 years and counting. So you've got these critical bottlenecks in Asia that are really constraining the build out. And as I say, we've done very well in the memory side, on the foundry side, and we'll increasingly be broadening out into other areas where we think those bottlenecks are going to start to appear. For example, in power, and also into other areas which you might not expect, like copper, as grid infrastructure needs to be built out. So I think the opportunities are very, very broad. The key will be saying disciplined evaluations and being dynamic and continue looking for the new opportunities as they arise. But I still think the semiconductor side has a decent upside to come, just given the extreme tightness in that market.
Can you help listeners by explaining what's been happening in the Korean market in the last few weeks, which has been particularly, you could even say, spectacularly volatile? How much of what we've seen with the market soaring this year and then dramatically falling for a period, does that anything to do with the liquidation of the situational awareness hedge fund or other factors like that? Or is this the kind of volatility you just have to get used to? What's your reading of what happened there?
Well, firstly, it's not normal. I haven't seen anything like that since the global financial crisis. Just the amount of volatility that we saw. You have big companies in July, the likes of Samsung and Hynix down, 40, 50%, and then bouncing in one day, 25, 30%. The historic moves that you just don't normally see. I suppose firstly it's worth putting it in perspective. Korea has been the best performing market by a long way since the start of the year. And even with the recent volatility in the shares coming off a bit, it's still by far been the best place to be in Asia. I think the volatility has really come a lot from, as you mentioned, leveraged ETFs, which had taken place in Korea, and hedge funds. But effectively, a lot of ETFs came in where retail investors could take on large amounts of debt 2 or 3 times and put them into specific stocks. And that has led to retail investors typically come in later into the cycle and getting their fingers burnt. My colleague today on the desk, so I don't know if these numbers are accurate, but he reckoned he had heard that about 4 to 5% of Korean households had margin calls in the past month. That's a huge number. So I think you've just seen valuations getting a little bit stretched and momentum picking up. And then a lot of retail investors with leverage coming to the market, plus hedge funds, which has made it an incredibly volatile market. I suppose for us, the key is, where are we now? And on a longer term view, looking out over the next 2 to 3 years, we still think things look pretty attractive in Korea. Ultimately, the growth in the market has been backed up by earnings growth. It hasn't just been a massive re-rating. So actually things look relatively cheap. You've got the value up program still ongoing, a bit like in Japan, and that's had a lot more teeth than I thought it would. So I think we're going to see policies that again start to support share prices significantly in the next 6 to 12 months. And we do like the companies. As I say, we have reduced some of the memory names, but we like those. And there are lots of really interesting cheap businesses, for example, in the engineering construction space where we've been adding to, where we think they'll play into some of the industry dynamics in the energy sector, which could be quite interesting given the current events in the Middle East and what that means for energy security over the next 4 to 5 years. And these are on low single-digit PE multiples with half their market caps in cash. So I think Korea looks still attractive, bit of froth built up in the market with retail investors and leverage.
Yes, I think a bit of froth might be a little bit of an understatement, but anyway, certainly a lot of froth. What has been the impact of Trump with his tariffs and more recently the Iran war? Had he not done those two things, how do you think your portfolio would have performed? I know that's a difficult question to answer. Well, what I'm trying to get at is how significant they've been as a driver of that volatility we've seen.
So on the tariff side, obviously that introduced an awful lot of volatility when it came in. But ultimately, I don't think it's had a huge amount of impact, certainly the impact people were expecting on Asia. Firstly, the big country that he was arguably targeting was China in all of this. And they essentially pushed back with reciprocal tariffs and the US backed down. And actually, exports from China have never been stronger. They are at record levels and continue to accelerate. So I don't think it's necessarily had the desired effect that the US was hoping for. And there were opportunities, or had been opportunities. One of our larger positions in the trust has been Vietnam, which has benefited hugely as one of the best exporting stories in all the emerging markets, and is one of the natural places where you go to if you want to diversify supply chains, which has probably been the biggest change we saw from tariffs. People looking to get a little bit out of China and go elsewhere. And that has typically benefited a handful of Asian countries, with Vietnam being the main one. So ultimately, not a huge amount of impact and some opportunities coming from it. In terms of the Iran war, I think that's harder to tell the impacts as yet. I think the first observation would just be how resilient Asia has actually been. If you go back over the past sort of 5-6 years, Asia's been remarkably robust. We've had the strongest dollar in 40 years, the most aggressive rate tightening cycle in a generation, and at any other time, this would have led to an Asian financial crisis. And it hasn't. And it's because the macro situation in Asia is much better than it's ever been. And now you throw in the biggest energy shock we've seen in a generation. And again, Asia has done relatively well throughout this. Now, if it continues, we will start to see parts of stress, but it will differ across the region. North Asia, I actually think, is fine. China's very well diversified here. It's got huge reserves, the most diverse energy mix, and arguably the cheapest energy in the world. So I think they come out of this probably stronger. Korea and Taiwan are fine economically because they have huge financial buffers. But there are areas such as India and ASEAN where they are significant energy importers. Rising fuel prices impact them far more significantly, and I would be more cautious there. So despite talking up the Vietnam story earlier, we have reduced that position quite significantly because this is ultimately a frontier market that could be much more susceptible to market shocks. And then finally, look, I suppose the question is, what are the opportunities? So I can go into those in a second, but we think the best thing we can do is look for the opportunities over the next 3 to 5 years to come out of what's happened in the Middle East. So, in particular, I think energy resilience is going to be a huge theme over the next 5 years. So it's looking where we can find opportunities in that space in Asia, where we'll be finding quite a few actually over the past 3 or 4 months.
What sort of things are we talking about?
Well, I suppose, big picture, well, apart from the UK, perhaps every other country is trying to make its energy security more resilient. So I think there's some fairly obvious long-term winners here. Firstly, I think oil itself probably takes quite a long time for markets to rebalance, and people will be looking to secure their own supplies and storage. So I think, quite simply put, oil does relatively well. But I think broader resilience is where the market is probably offering quite a bit of value. So green energy, where we had been relatively light in over the past 12 to 18 months, I think there are opportunities in batteries. And so we've been adding quite a bit to CATL in China, the largest battery maker in the world, where large energy storage systems, which are crucial for green power, are seeing very significant demand. Likewise, businesses like Sungrow that do inverters for those storage systems, and possibly solar itself and electric vehicles. We hadn't really invested in directly in electric vehicles for some time, but already we're seeing demand picking up a lot. The last time I was out in Thailand, I drove past a BYD showroom, and you can't even get in at the moment. There's a 3-week waiting list just to get into a BYD showroom in the country. And then finally, where I think you've probably got the most upside is in the likely infrastructure build out, particularly in areas like refineries, petrochemicals, and storage. And in Asia, there are a few businesses that should do very well out of that. In Korea, as I mentioned earlier, we've added to or bought new holdings in companies like Samsung E&C, which is an engineering and construction business with a particular speciality in the Middle East in petrochemical and refining business. And it's an industry that's been quite weak for a decade. So a lot of players have exited the market. So there's going to be a tightness in supply, both in terms of components, but also manpower. So I think you can see very strong order books in these businesses, and that is when the share prices really do start to move. And they're very operationally geared, and they're not expensive. As I say, they're on low single-digit P multiples, nearly half their market cap often in cash. So that's where I'd be looking really closely, would be Asian businesses involved in that infrastructure build-out over the next 5 years.
What's the worst thing that could happen as far as your portfolio is concerned? A lot of people are worried about the scale of US debt and the fiscal position of lots of other countries in Europe. Asia, as you said, has been much more resilient, but is not going to be immune from any kind of crisis that develops in the bond market, say in the US or in Europe, is it?
I don't think Asia or EM is immune to a serious crisis in the US or Western economies. A significant recession in the US or a dramatic, prolonged spike in energy prices will ultimately cause issues in these countries. Now, the macro is much better than it's been before. As I say, in many ways, the Western countries, including the US, are the ones that have behaved like emerging market countries of old. They've had the unorthodox policies, the printing money, the negative interest rates, whereas Asia has actually been pretty well behaved. We've had net capital outflows for more than 12 years in the region. So they haven't been able to rely on foreign financing, so they've had to behave pretty well. So they've had real sensible interest rates, they hadn't done any QE or printing money, etc., etc. Inflation's under control. So the macro position's pretty strong. So there are buffers there that there haven't been in the past. So in many ways, if you find that the US and Europe is weak but not collapsing, that's probably not a bad environment for Asia, especially if the dollar starts to weaken. That's a huge tailwind, and actually probably get some pretty decent relative outperformance from the region. But anything really serious, particularly in the US, we will not be immune.
Indeed. One of the big issues that many investors seem to have is there's a lot of difference of opinion about China. What's happening to growth there? What's happening to the demographics and so on? You've said, I think, that you've been overweight in China relative to your benchmark. So what's your interpretation of the Chinese outlook, and how important is that for the region as a whole?
I would be really quite positive on China at the moment, particularly on the stock market, given where sentiment and valuations are. We might not have turbocharged growth, but it's going to be reasonable, and valuations have really nothing in it for that. We've been adding to China for the past couple of years, and it'd be our largest overweight position. And what I think is interesting is that China's gone from being Asia's and emerging markets' biggest drag to, I think, potentially its biggest tailwind. And I think to understand why, you've got to go really back to probably 2018 when the US restricted semiconductors to China and the trade war really began. Now that really panicked China, and its response was to de-Westernize its industrial base. And it did that by taking its huge domestic savings and redirecting them away from property and into industry. And if you look at the numbers, you'll see lending to property just collapsing off a cliff and lending to industry surging. It's the kind of thing you just don't see outside of wartime. It's a very dramatic event. Now that drove two enormous deflationary forces that have been big problems for the economy. First, you had a brutal property crash with 7 years of falling house prices, which decimated consumer confidence, and a massive surge in industrial capacity. Now the world has really fixated on the bust. And, fair enough, China took a huge amount of pain. Property prices going down 30 to 50%, and equity and consumer markets getting absolutely hammered. But I think what people are missing is what China really built through that pain, which is a world industrial leader. Cars are a great example. In 2020, China barely exported any cars. Today, it's the largest exporter in the world. And the quality and innovation are extraordinary. I drove one in China recently with a drone built into the roof, which you can launch into traffic jams to show you what's happening ahead. So they are really good pieces of kit. And it's not just cars, batteries, solar, robotics. China hasn't just caught up. In many areas, it's leapfrogged the West. So my point is that China has, at great cost, won the trade war. And now, crucially, policy is shifting back towards the domestic economy. They're clearly putting a floor under housing. They're stimulating the economy and supporting the stock market. And that could be huge. Just put it in perspective, Chinese households have had nowhere really to put their savings for the past several years. It's just been going into bank deposits, which has swollen to about $23 trillion. 10% of that just shifted into equities. That's nearly $2.5 trillion coming into the market. That's going to be pretty exciting. And then the final leg to this is you've got the renminbi, which for years has been really cheap to support exporters. But if the priority now is the actual domestic economy, you want a stronger currency, and that's exactly what we started to see. So it's a rather long answer, but the world, in my opinion, is still focused on what broke in China, but is really missing what they built through that pain, which was an industrial superpower. And now you've got policy shifting back towards the domestic market and the RMB going up. And I think that's a pretty bullish outlook for China over the next 5 years.
Going back to the investment trust, you are one of 4 trusts in the Asia-Pacific sector, soon to become 3 as the result of Pacific assets being merged into one of the 2 larger Schroeder Asia-Pacific trusts that make up the rest of the sector. If I was to come to you as an outsider and say, why should I invest in your trust rather than in one of the 2 other large liquid trusts managed by Schroders? What would be your answer? I ask this partly because I'm aware that many investors who are in your trust will also be asking that question, as you have a continuation vote coming up in the autumn, a 5-year continuation vote.
I think it's a very fair and valid question. I suppose I'd start with, we've been managing the trust for over 30 years, and it does have an excellent track record, probably the best over most long-term time period. So it has added significant alpha for clients. And I think we've achieved that by having a differentiated approach. We are very much focused on growth companies, and that's because we think Asia is a growth market. And the best way to gear into that is by investing in growth companies. That's where growth squared comes from, as you alluded to at the start. But we've been successful for 30 years because we have combined that with flexibility. We don't want to just be invested in any one type of growth. We don't want to be all in technology. We don't want to all be in steady growth businesses. So we have a broad portfolio across different buckets of growth, from rapid growth, steady growth, and cyclical growth. And we are willing to move between those. So generally speaking, through the cycle, we have done pretty well. So yes, given our strong growth bias and our conviction, we can be volatile, but over the long period of time, I think that is the best way to add value for clients, and the numbers would be supportive of that view.
Now, if I can mention this, unlike some of your colleagues managing investment trusts at Baillie Gifford, you haven't had to deal with the presence of Saba Capital as a prominent name on your share register. But you do have a large shareholder in the shape of City of London, who are also very interested in discounts and their movement over time. What can you say about the discount? It's around 9%, I think, something like that at the moment. Obviously, as the manager of the trust, it's not directly your responsibility. But do you think the discount needs to come in a little bit further? Or are you happy with it where it is around that 9-10% level? It has been wider more recently. I think it went out to 15% at one point.
Yeah. So, if you look at the numbers, we have certainly been doing significant buybacks. If you go back over the past 12 months, we would have bought back around about £70 million worth of stock, I believe. And the discount has typically been at 10% or less. So you can see that we are actively getting involved in the market and doing what we can to bring in that discount. And I certainly think that is what a number of shareholders would like to see and don't want the discount blowing out. I suppose the challenge is that despite doing quite a lot of buybacks, as I say, 70 million in the past year, I think about 12 million over the past month, it doesn't seem to shift the discount a huge amount. So I suppose the question is, ultimately, how much of an impact can you make? And we've been doing pretty big buybacks with pretty good performance, and that hasn't seemed to have shifted where we are as of yet. So I think we're keen to keep the discount at reasonable levels. We've certainly been very active, but it's probably a little bit disappointing that we haven't had more impact given the performance numbers and the quantum of the buybacks that we've been making.
Many fund managers say that given a choice, they have a mild preference for running an investment trust rather than an open-ended fund at the margin, because you have a bit more flexibility. You can, in theory, be more patient and so on. But that hasn't held quite so much, has it, over the last 3-4 years? Discounts have widened, and a lot of trusts have had to concentrate their portfolios, sharpen up their act, that kind of thing. Do you think that's a positive or a negative, or have you been aware of that? You must have been aware of that at your shoulder.
Yeah, I mean, it's certainly been a more challenging period for the sector as a whole. And I think, a lot of trusts have been doing their best to grinding discounts to keep them in and offering tender mechanisms or bigger buybacks. I suppose the challenge from an investor's perspective, my perspective of managing a trust and also your clients investing in the trust, is that perhaps the biggest attraction and the reason why trusts have historically performed better than open-ended vehicles or many other types of vehicles is that they are closed-ended. And as you start doing very significant buybacks or very significant tenders, ultimately, do you start to still be a closed-ended trust, or are you becoming an open-ended trust in reality? So I suppose that's the tension with trying to keep the discounts in and buying back shares.
Yes, I think you put that very well. That's exactly how I would see it, at least. The best way to deal with a wide discount, of course, is to deliver performance, and you've certainly done that over the last 12 to 18 months. Though I suppose I have to ask this question, which is typically when you have a period of exceptionally strong performance like you have had, I think at one point over 12 months you were up 90%, something like that in share price terms. That kind of rate of growth can't go on forever. But for the moment, you still see plenty of positives in place. That's what I'm hearing from you. You talked about valuations looking attractive, and there being tailwinds like the US dollar weakening. So even after the very strong recent performance, you're still holding to that positive outlook.
Yeah, absolutely. And I think you've got to keep these things in context. I've generally been positive on Asia for a long time, but if I'm totally honest, it hasn't been a good place to invest for a decade. You would have made 2 or 3 times the amount of money over the previous 10 years if you'd invested in the US or world markets. So Asia, yes, it's had a good run over the past 12 months. That's against the backdrop of being really quite disappointing. What I think is encouraging is that I think the things look very attractive and well set up going forward. Valuations remain at record lows versus developed markets. As we discussed, they have never been more resilient in my view. Asian markets, the macro is better than the West. They are the ones that have behaved in an orthodox manner. And growth will be faster, or growth will be faster than developed markets. Indeed, Asia will likely be the fastest growing region over the coming decades. You've had 2 big headwinds holding it back. That's China. And as I mentioned, I think that's at a turning point and is potentially become the biggest tailwind for the region. And the dollar has been a major headwind, the strength of that, the strongest in 40 years. And I think there are structural reasons why that comes down over the next 5 years. And that will be a major tailwind for the region. So you combine that with stocks that look pretty good value to me at the portfolio level. And I think the setup still looks pretty good on a 3 to 5 year time horizon. And I personally remain fully invested in the trust.
Splendid. Well, let's hope that your optimism on those scores is justified. So that was Roddy Snell, the lead manager of Pacific Horizon Investment Trust, ticker PHI, managed by Baillie Gifford. You are listening to the Moneymakers podcast. To keep up with every single item of news from the investment trust sector and all the latest share price, NAV and discount movements, why not try a subscription to the Moneymakers Circle, our premium content newsletter? You'll find there our in-depth independent profiles of more than 200 investment trusts and more commentary. Go to money-makers.co for more details. Do please like, subscribe and share through whatever platform you're using. As well as the usual podcast channels, we can also be found on YouTube, TikTok, X, Blue Sky, and most recently on Substack. Visit the website for more details. Next up on the podcast is Nish Patel, who, as I mentioned earlier, is the lead manager of the Global Smaller Companies Trust, which is managed by Columbia Threadneedle, and is one of 4 remaining trusts that sit in the global smaller companies sector. A very mixed bag they are too. They include 2 of the trusts which have been very much in the headlights as far as Saba Capital is concerned, namely Edinburgh Worldwide, where Saba has ousted the board, and Herald, another trust in which Saba has a significant shareholding and has engineered change. In this case, Katie Potts and her team, who've been managing Herald for many, many years, having moved to Aberdeen after completing a tender offer which saw significant redemptions. The 4th trust in this particular sector is the North Atlantic Smaller Companies Trust, a very idiosyncratic vehicle which is part of the Harwood Capital stable led by Christopher Mills. The Global Smaller Companies Trust, it's important to note, has not been the target of a significant raid by Saba Capital, although it did once have a small shareholding, but has since relinquished it. The Global Smaller Companies Trust has a long history, dating back originally to 1889, when it was something called the Alliance Investment Company, not to be confused with the Alliance Investment Trust, which is a separate entity. Global Smaller Companies Trust is for many years part of Foreign and Colonial and has followed it to Columbia Threadneedle, following the takeover of their foreign and colonial interests a few years ago. Nish Patel has been working at F&C since 2007 and is the lead manager of this trust since 2 years ago, since when it's been undergoing a significant reshaping in an effort, I think, to improve its rating and performance. So a couple of questions, Nish, I'm going to be putting to you. One is, why should we be thinking about investing in global small companies today? And as a corollary to that, why invest in your particular trust rather than the other trusts that I've mentioned, the diminishing pool that remains? And then the second question is to talk about the challenging environment we've been living through over the last 5 years, particularly interesting and volatile period. As you haven't been on the podcast before, Nish, perhaps you'd like to start by giving us the 1-minute summary of what the Global Smaller Companies Trust is, and we'll get on to how it differs from your peers in a moment.
Well, thank you for having me on the show, Jonathan. So the Global Smaller Companies Trust, as you mentioned, is a very old trust. It was founded in 1889. So we have about 900 million of assets within this trust. And our objective really is to deliver a high risk-adjusted total return by investing in what we think are the very best bottom-up small cap opportunities all over the world. It's a quality value strategy. So we look to take a long-term conservative approach to investing in really high quality small cap businesses, but we do this in an opportunistic way. We're looking to buy into these companies when they are out of favor and they are available at a significant discount to what we think they are intrinsically worth. Now, the small cap market is at a very interesting juncture today. It's been in a relative bear market to larger companies for almost 14 years, but it is starting to show signs of life. In fact, in the first half of this year, smaller companies outperformed larger companies by about 5%. So I think investors are starting to look at a potential opportunity here. And some of the reasons why that might be, well, I think first of all, the valuations are much more appealing in small cap versus large cap. Larger companies is a very crowded trade, I would say, particularly in the US. And if you're looking for diversification, smaller companies has its appeal. And also smaller companies generally tend to do well in inflationary times. And we are certainly in that sort of a period of structurally higher inflation. So we think that that is helpful for the asset class. And the way that we are positioned, we are a clean way of participating in a small cap cycle that we think can last for several years. If you look back at history, when smaller companies start to turn, they do outperform for a long period, for 10 plus years or so. So that gets us really excited.
Yes, I think it's well chronicled why the smaller companies sector has developed in the way that it did. It was only in the latter half of the last century that people woke up to the long-term outperformance of small-cap stocks as it appeared at the time. So that historical evidence for superior returns has been somewhat eroded by the experience of the last few years, I would say. I'd like to start by picking up on one thing you said, which is that they tend to do well in periods of inflation. Now, at the moment, we're seeing a period of rising interest rates, particularly at the long end of the yield curve. And that traditionally has been something of a challenge for smaller company shares over time, has it not? And of course, the reason for that being the threat of higher inflation than was anticipated. Is that not right?
So I think in general, one would say that smaller companies are more sensitive to rising interest rates because more of them are on floating rate debt agreements. So as interest rates rise, they tend to see the impact of that come through quicker onto their P&L than larger companies, which a lot of them are on fixed rate debt. But the context is very important because higher interest rates generally, okay, they lift the discount rate that an investor would apply to the cash flows of a business, and that does compress the valuations of those companies. And if your cash flows are well out into the future, i.e. if you're a longer duration asset, then that hurts you more. And smaller companies do have lots of longer duration assets in there. But in today's environment, actually, larger companies are also very exposed to long duration assets. So I think smaller companies relative to larger companies will probably do better than they've done in the past. The other thing to note is that higher rates generally tend to affect higher valuation companies more than lower valuation companies. And today, small caps are on a significantly lower valuation than large caps. So that, again, that gives some relative protection. And of course, you need to take into account inflation as well. So if rates are going up because of higher inflation, then you want to be involved in more of the sectors that do well in inflationary times. And a lot of those companies are in the sectors of energy, materials, industrials, those old world sectors. And the small cap market is more exposed to them. About a third of the small cap market is in those sectors, versus the large cap market, where it's only represented by 15% within those sectors. Large cap is more kind of growthy, and I think those companies tend to do worse in inflationary times and higher interest rate times. So we are well positioned as a trust for higher rates. We've got quite a diverse portfolio. So we do have a lot of beneficiaries of higher interest rates. The leverage levels are pretty low in our portfolio. So we're only levered at 1x net debt to EBITDA. So we think we're really well positioned. We've got lots of exposure to those beneficiaries of inflation, such as industrials, materials, and energy. So we're well placed.
I suppose, put this another way, we do know that the market until this year has been dominated by the Mag 7 and a small number of other large cap stocks, not just in the US, but also in other markets, including Asia, particularly stocks with a technology bias, where the potential winners or losers from the AI revolution has been a dominant concern of investors. So I guess what you're hoping is that what we've seen this year, which has been some moderation in that effect, the mega cap stocks and the tech giants are still powering ahead, but they're not doing it in quite the same dominating way as they did before. And are you actually seeing evidence of that in your performance over the last 12 months?
Yes, you're quite right that we look very different to that AI trade. And the Magnificent Seven have done extremely well. It's a very crowded, very consensus trade. The expectations are quite high, and the earnings on a cyclically adjusted basis are quite high levels as well. So they don't have a lot of room for disappointment. But we do provide some protection from that AI trade, in the sense that if you look at the way that this fund is correlated versus the Magnificent Seven, we're about 20% correlated to the Magnificent Seven. That is much lower than the S&P 500, which is almost 90% correlated, and the MSCI World, which is about 80% correlated. So we look very different from that AI overall sort of basket. And the reason why is that we're underweight the US. We have a lot of international exposure, including emerging markets. We have more of a value bias to this trust. So that does provide something that's completely different. So you're getting a collection here of high quality, undervalued companies that we think will grow reliably, whatever happens in quite an uncertain environment. And if you look at our performance, we've certainly done better when that AI trade has come off. So certainly June was a better month for us. July was a good month for us. So as that enthusiasm wanes, that should be helpful for us.
We haven't talked about the peer group yet. As I said, they're very different animals to your trust. Two of them have been in the eye line of Saba Capital and been forced into radical changes as a result. Even though you don't have Saba on your share register now, you have also made some significant changes in the way you manage your portfolio. Perhaps you could describe that and what the motivation is that. Would it be unfair to say that maybe you've noticed that Saba Capital has been on the case of other global smaller companies trusts and felt the need to take some rather more dramatic action to improve the rating of the trust and its performance?
Well, I think we've always been through a process of evolution throughout the history of this trust, and we've always tried to manage the portfolio in a better way. Now, I took over as lead manager in 2024, and having been involved with this trust really since 2007, there were a number of things that I thought could be done better. I thought the core philosophy is an excellent way of managing small cap money in terms of quality value. So I'm a key proponent of that philosophy, but there were things that we could do from a structural point of view to the trust to make it a better proposition. So one of the things that we started with really in 2024 was we looked at the discount, and the discount was almost 13%, and it had indeed widened out even further to 17%, and that's clearly too wide. So we wanted to do something about that. And the things that we did were we changed the way that we approached the buyback process. We spent a lot of time increasing awareness of this trust and doing some marketing. And that was very helpful in bringing the discount in. So today, the discount is around 5%. So we've made a lot of progress on narrowing the discount, which we're pleased about and hope that that continues. And then on the investment side, this trust used to be managed by BMO Global Asset Management, and BMO was bought by Columbia Threadneedle. And that opened up lots of new opportunities for us to take advantage of additional resources. So, for example, Columbia Threadneedle had a very good Japanese equities team that had a very large multi-manager team that had experience in picking third-party funds, which would prove very useful for us because we do have emerging markets managed by third-party houses. So those were resources that we took advantage of. And then we started to reduce the number of holdings as well. I always felt that having over 200 holdings was too much. And we had 213 holdings at one point. And I wanted to bring that down significantly. And we made efforts to bring it down. We brought it down to 186. But then we reached somewhat of an obstacle in the sense that the trust was managed in a fund of fund structure. And when you're in a fund of fund structure, that naturally means that you have quite a few holdings. So we needed to change that structure in order to bring the number of holdings down further. So from the start of May, we moved from a fund of fund model to a single portfolio of our highest conviction ideas. And we brought the number of holdings down to 125. At the same time, we've also changed our benchmark as well, because we used to have a hybrid benchmark, and the hybrid benchmark allocated 20% to the UK. And as you know, Jonathan, unfortunately, the UK has become a much smaller part of the world markets. It's less than 4% now. So for simplicity, we've moved to an all-country world MSCI small cap index. So that's a simplified proposition. So we've made a number of sensible changes that we think really position this trust very well for a market that seems to be moving towards it.
Right, so you've got the discount down to around 5% or so, which has obviously been helpful for the returns experienced by shareholders. Looking at the performance numbers over time, over 1 and 3 years, you've performed less well than Edinburgh Worldwide and Herald, where there have been these well-publicised goings-on, but they started with bigger discounts than yours, so that's obviously a factor now that they've seen their discounts come in. While it has been the activism there which has helped trigger these results, in your case, it's been more a case of self-help. Over 5 years, you've performed at least as well as the other trusts, and over 10 years, just a little bit below. So I guess what I'm saying is it's quite difficult to get a read on exactly what investors should feel about the performance of this trust. How would you describe it? You said these changes, you described them as necessary and desirable, and reflected the fact that the performance over a number of years has been relatively disappointing. Would I be wrong in drawing that conclusion?
Well, I think you're right in the sense that we are looking to improve performance, and we think these changes will be helpful. Our long-term performance, so the share price is compounded almost tenfold over 25 years, which is well in excess of the major indices. So we know that the quality and value combination works well, and you are capturing that quality premium and valuation premium, which are well known amongst market participants. So that philosophy is the right one. It's been a very difficult period for quality investors more broadly. It's been a very momentum-led market. And certainly in the last 12 months or so, it's been interesting to see that actually the best performing companies within the small cap universe are the ones with the lowest profitability and the highest volatility. So it's become a more of a speculative market that we're in at the moment, which makes it difficult for a quality value style. Clearly, the AI trade has been front of people's minds. We have had a lot of companies that have benefited from the AI trade that have done well for us, but we clearly haven't had enough of them. Some of that is because they don't meet our criteria in terms of the types of companies we want to invest in. And when you're in this sort of an environment, you do have a choice. You can chase the kind of non-profitable, riskier companies in the marketplace that do badly over time and try and get out of them before they turn down. That's very difficult to do. Or you can stick to your process, which is what we are doing, and look for opportunities and try and make improvements. So we know that the tide has been against us, but we are confident that it will return and come back into favour.
Looking at the trust from the outside, if you are a professional investor who dominate your share register at the moment, you can see the attractions of what you're offering in terms of some of the technical terms we use. You've got a relatively low beta, that means sensitivity to the overall market movements. You've got a very significant and high active share, meaning what you're offering is very different to what you'll find by buying a tracker fund or ETF that does the same thing as you. So you've been doing what actively managed should be doing, which is having a distinctive style and using stock picking rather than just asset allocation to generate your returns. But now you're saying that the board is looking to broaden participation on the share register. You're spending more money in marketing and aiming at the retail market, like many other trusts. You've made the portfolio more concentrated. I'm just wondering how hard a sell that is going to be when you try to reach out to the retail market. Because these technical arguments that basically suggest that you're offering something different and therefore significant diversification value may not be immediately obvious to less sophisticated investors.
Well, I think there are a number of ways to look at this in terms of investment case. So clearly we would benefit if the small cap market comes back into favour. That would help us. Our investors would also benefit if quality value generally comes back into favour. If the marketplace starts to reward higher quality businesses, again, that's additional returns that they can take advantage of. And then the structural changes that we've made that we think put us in a really good position to kind of protect and compound capital. Those things should bear fruit at some point. And then finally, we do look very different to other funds, to the major indices. So we do give our investors some diversification. So I think those are the main kind of pillars of the investment case today.
You mentioned already the regional allocation of the trust. In terms of the underlying exposures that you have in that regard, could you summarize what your relative positions are in North America, Europe, Japan, and so on?
So we are underweight North America at the moment. And the reason why is that we do think the market is somewhat more speculative. It looks expensive on an absolute basis. So we're underweight there, almost 10% today. So that's quite a big margin. We're finding a lot of opportunities in UK and Europe. Those markets are much better value, particularly the UK. We've had a number of takeovers in the UK side of this trust. We had 5 takeovers in the last financial year. Japan looks really interesting to us. We're overweight Japan by 2%. And really, since 2023, we've found a lot of opportunities within the areas of companies that are trying to improve their capital allocation policies. So the Tokyo Stock Exchange is very hot on this. They do want companies that are trading below book value in Japan to show some strategy to try and improve that rating. So many of them are buying back their own shares. They're installing dividends. They're selling cross shareholdings. And a lot of that sort of thing is happening within the small cap universe within Japan, which is where we focus. So we've had good success there, and we're still finding lots of opportunities there. So we're overweight there. And we're about sort of equal weight in the rest of the world, which includes the emerging markets.
Could you quickly put some numbers around that in terms of valuations and how they compare to the relevant indices?
So I'd say we look at the North American market, that's historically traded on sort of 17, 18 times earnings. And we're sort of above that at the moment. We're about 19-ish times earnings at the moment. The UK is much cheaper. So a lot of our companies that we've invested in the UK are around about 12 or 13 times earnings. So significantly lower than that. Europe is about 16 times earnings. And then a lot of the companies within Japan, actually, we've invested in a lot of companies that are below book value because they're benefiting from the corporate reform that's ongoing in Japan.
I should also ask you about the dividend. Your trust is one of the AIC's dividend heroes, meaning trusts that have increased their dividend every year for a number of years. And the Global Smaller Companies Trust ranks number 5 in that list. It's been 56 years of consecutive increases, which is an impressive statistic. But the dividend yield, it's fair to say, is pretty small. It's only around 1.6%. So you're not going to make a significant income return from investing in this trust, though the consistency of the dividend growth is, of course, helpful. What I'm getting to is whether you're actually seeing more demand at the margin coming in for this trust. The discount has come in, so that's clearly some evidence of an improved balance between supply and demand. But you've also been repurchasing shares, buybacks around 6% of the trust in the last reporting period. Is there going to be more of that in the future?
The dividend is not the main part of the story for this trust. It is mostly about capital return, but the dividend is a function of the companies that we've invested in. So we've invested in companies that generate lots of cash flow, and they look to return the cash flow to shareholders. And because their cash flows are growing, that's allowed us to raise our dividend. Now, the dividend yield is not a big yield, it's under 2%, but the dividend itself has been growing quite nicely. It's been compounding in the double-digit rate over time. So we do feel that on the initial investment that investors make, that the dividend could add up to a sizable amount over time.
The other thing I wanted to mention was, as you've alluded to already, the fact that you moved away from what was primarily a fund-of-funds model, where the trust invested across a range of other funds, towards a more centralized and stock-specific approach. However, you still have nearly 20% of the trust portfolio in the form of other funds, including a couple of investment trusts. Perhaps you could describe why you still do that, as you've been moving to a more active management role as the lead manager, and also why in particular you've chosen these particular vehicles to gain that exposure. One of them is Pacific Horizon, an investment trust which we've just been talking to the manager.
So the reason why we have third-party funds is because we don't have the capability in-house at Columbia Threadneedle to manage smaller companies within the emerging markets in a similar way to that we're doing in the developed markets. So we do use third-party funds, but they are picked using a multi-manager process. And we do have a large and very well-resourced multi-manager team that have a very stringent process in picking third-party funds, and that's the one that we employ. The funds that we own within this part of the trust, so it's a collection. You mentioned the investment trusts. So we've got Scottish Oriental in here, which is a trust that is focused mostly on consumer-related companies. Again, it's a quality-focused fund. So all of the funds that we've invested in are mostly quality-focused with valuation discipline. It's an experienced team. They have good exposure to India, and it's trading on a significant discount as well. The Utilico Trust offers us something different in the sense that it's emerging markets within emerging markets utilities. So these are businesses that are very stable just by their inherent nature. But at the same time, they are still offering growth because they are located in fast-growing parts of the world. And the cash flows from a lot of these businesses are inflation protected, which is attractive. And then we have a collection of funds that are sort of more core funds that have a very balanced exposure across Asia. So that includes Templeton and Schroders, very experienced teams, really good long-term track records, focus on good quality companies, very stable sort of funds with little turnover in terms of personnel. So those are attractive funds to be in.
In terms of performance, if we look collectively at those 5 funds and investment trusts taken together, have they actually outperformed? Have they added value to the portfolio overall? You are, of course, paying extra fees in the case of some of them.
We are, so similar to the other parts of the trust, in the last year, they've had a more difficult year because they are quality focused and quality's been out of favor in the last year. So they've not done well in the last year or so, but individually, these funds have got very good long-term track records. So we do have faith in the process that the managers employ and the people, but they are similar to other parts of this trust suffering from the sort of quality discount that's happening at the moment.
Finally, then, perhaps I could ask you about the current environment. You've been involved in managing in this area, global smaller companies, for getting on for 20 years. There's obviously a lot of geopolitical risk out there been manifesting itself. We're moving from a low interest rate environment to a rising interest rate environment. And there's obviously plenty of discussion around issues of style and momentum. How do you reflect on what is going on in the environment at the moment?
So you're quite right. It's been a number of changes in the last 5 years. And really, it's been very difficult for active managers broadly as a group. Most active funds are behind their benchmarks, particularly in the small cap universe. There's been a very narrow market as well. It's been led by fewer sectors and geographies and companies, and that has made it difficult. Now, we as investors are very focused on the way that we manage money in terms of we think it's the right way of managing money in terms of finding good businesses and buying them when they're significantly undervalued. We think that's the right way of doing things. But we do have to adapt to the new marketplace that we're involved in today. The market today is very momentum driven. And I think part of the reason why is that if you look at the market participants today, they are different to what's happened in the past. A lot of the trading volume today is driven by passive flows, by algorithmic trading, by quantitative funds. And a lot of those strategies are very price insensitive and they are very momentum driven. Now, in that type of environment, you do need to change the way that you approach fund management. If you're a quality and a value focused manager in an environment that is largely momentum driven, what you may find is that a lot of the companies that continue to do well in terms of share price performance, there's no sort of upper limit on how far they can go. Valuation does not seem to be constraining them at the top. And similarly, companies that are doing badly in terms of share price performance continue to underperform, and valuation doesn't seem to be a support at the bottom. So what you do need to do is try and adapt to that type of an environment and just be a bit more careful in the way that you're purchasing new positions, for example. So you do need to wait for some stability in the momentum factor before perhaps taking a full position in a company, because you could be too early. And similarly, when companies start to exhibit negative price momentum, you do need to be quick to try and cut your losses, particularly in cyclical businesses. So it's a new environment. It's been driven largely by the nature of the participants within the marketplace, but we are sticking to what we do. We're just making adaptations at the edges just to take account of the world we're living in.
I guess, therefore, the message I'm taking away from what you've been saying is that for your trust to gallop, if you like, there do need to be some changes in the factors that have been driving markets over the last few years. But you have some confidence that that is indeed about to happen.
Yes, I mean, those would be helpful. To some extent, it's largely out of our control when those factors come back into favor or not. So we are controlling what we can. We have made several changes to the trust that we think put us in a really good position. The portfolio is a very high quality portfolio versus the benchmark. It's got higher margins, higher returns. It's got a very low level of leverage. At the same time, the portfolio is undervalued versus the benchmark as well. So we think we've got the right companies in the portfolio. They are delivering in terms of earnings growth, which is good to see. And if the market does turn towards us in terms of style, that will be helpful.
So that was Nish Patel, the lead manager of the Global Smaller Companies Trust, managed by Columbia Threadneedle, speaking to me a few days ago.
Thank you for listening to the Moneymakers Investment Trust podcast, sponsored by JP Morgan Asset Management and independently produced and edited by Moneymakers. If you like what you have heard, do tell your friends and colleagues, and remember to subscribe through your favourite podcast app or at the website so you never miss an episode. And follow us on our social media channels. For more news, commentary and other investment trust content, don't forget to look at the Moneymakers Circle, available for a modest subscription. All details are at the website money-makers.co. Podcasts are provided for educational purposes only, and nothing you have heard from any speaker should be regarded as constituting investment advice.